This is our Forex blog for December 12th, 2011. And like you want to do most days, you want to buy the strongest currencies versus the weakest. We compare the dollar to every other pair and the yen to every other pair and so on and so forth. And the histogram shows the real-time strength or weakness, and it's made up of 5 of our different statistical tools. Rather than watch and try to decipher 5 different indicators in histogram form, which would take up too much space for one, and the human brain just can't do that. We've averaged those together. 3 of them measure the direction that the dollar's going up or down, and 2 of them measure the intensity of that direction. So just like, you know, in football, the bigger the guy and the faster he's running, the harder he hits. Same thing with this. The more dollar pairs are going up and the more intensely they do, the higher the reading you have here. And in a nutshell, if the real-time momentum you see like this is followed by a counter trend wave of, you know, 1/3 to 1/2, then that trend's likely to continue. The odds of it continuing are even higher if the daily trend's up, the weekly trend's up, and the monthly trend's up. Of the 3, I mostly care most about the daily and the weekly. The monthly can take too long to change, and as intraday traders that are looking to catch 10 to 100 pip moves, you know, we don't care if the monthly trend's in our way or not. But if the monthly trend, daily trend, and weekly trend are all in your direction, then you can trade a little bit more lot size and your odds go up. So it's obviously more fun to trade when they're all lined up, as you can see here in the dollar and the yen. So the dollar and the yen were the 2 strongest ones, and at 5:30 the pound was one of the strongest ones. The daily and weekly trends up. This is a perfect example of why you shouldn't really care too much if the monthly trend's down. It stayed very strong for another 5.5 hours. So these 3 strong currencies you want to, you know, buy against the weakest ones, or if the weakest ones are on top, like the euro is always on top, you want to sell the euro against the dollar, the yen, and later on the pound. Now the second weakest one, or actually the first weakest one's the New Zealand. Then you got, you know, here at 7, the Swiss is pretty weak. The weekly trend's down, the monthly trend's extremely down. As you can see, darker red means, you know, even more so. In that upwards, counter trend upwards move, you know, you can see kind of fizzled out right here. And when you see a weekly monthly trend that's down and the counter trend move up is dying of strength, it's pretty safe to assume that it will revert back to its prevalent trend, which is down. Slightly down on the weekly basis and extremely down on the monthly. So let's look at some of the charts. We want to sell the euro dollar and euro yen. Notice coming into today, prices underneath the hourly, that's one of our filters. Comes back up to the hourly, a few pips away from it here. Good place to sell. It goes down. It has a counter trend move up here. You might have shorted here and broke even or made a few pips and then shorted again. And you always want to draw your fibs on these to get an idea of where your profit target is. The first fib target's a good place to get out if it's underneath the lower containment band. The lower containment band's price typically either goes sideways or reverses. But when it's way underneath the lower band, typically reverses. Today it didn't, but most days it will. When you see extreme weakness like this with no strength whatsoever, it's usually best to wait for a double bottom. You know, you might have considered buying right here, which didn't pan out, but you wouldn't have lost money there. And once, if you do want to do counter trend in the safest way possible, draw your fibs on there. And, you know, this area right here would have been a good place to buy if the price had broken out above those bars high, which it didn't. So it's probably likely hit its low of the day, and it's pretty safe to aggressively buy down there now. When it's way underneath the 2.0 white band, especially after a currency's made at least 3 waves down, you can see 1 wave, 2 waves sideways, you could maybe consider this the 3rd wave, and then this is the 4th wave. If you drew your fibs from this, the beginning of the day to here, you can see it's right at the 1.382. So it may go a little bit lower, but it's not likely to go below the 1.618, which might be at 31.50. You could get into a trade from 80 down to 50 and scale in progressively bigger, and you more than likely would get a 50 or 80 pip counter trend bounce because it's gone down too far. Once the market's gone down too far, it becomes really risky to sell underneath here. It's actually safer to look for counter trend trades. As you can see, it's gone up about 15 pips from that level. You can catch a lot of pips, you know, doing counter trend trades. Actually, let me also show the range chart. Here's the euro dollar on a 6 pips per bar chart, which really gives you much better entries. when you see a currency that's trending down, wait for at least a 15 to 25 pip counter trend move. So from 30, it would be the minimum entry price would be 33.15. I would prefer somewhere between 20 and 25, as you can see. As it goes up, wait for one red bar, and when you get a red bar, you sell it when it goes 1 pip below that low. It didn't here. Here's another instance of that. When it goes below that low, you sell it with your stop just above that bar's high. And you can customize the number of pips per bar. This is a range chart, which means every 6 pips there's a new bar. Now, if during a bar there's a big news announcement and it gaps up 30 pips, you're going to see a bar of 30 pips. But barring gaps, each bar is 6 pips. So by putting your stop 1, 2, or 3 pips above the high, you're risking about 10 pips here. 6 pips plus 1 or 2 pips padding plus a spread. You got a 10 pip stop, and your profit target is off of the last drop. Here's your profit target. And it doesn't always go to the 1.382 fib target. Most of the time, you have this support area right here. I would use this to estimate my profit target at 84. But you got about a 25 pip potential profit while risking 10 pips. And that's really the key to trading. The momentum was to the downside. This counter trend move had almost no strength. The daily, weekly, monthly trend is extremely down. So it's pretty much a no-brainer to get short there. And as you can see, our trailing stop did a really good job of getting out right here at 70. You estimated you would make 25 pips on this trade, but you actually made about 40. You made 15 pips more than you estimated. So sometimes you make less pips, considerably less pips sometimes than you estimate, and other times you pick up another 10, 15, and sometimes 30 or 40 pips. Let's look at the euro yen. Another weak one. Daily, weekly, monthly trends down. Price is underneath the hourly, so it's more likely to go down. As you zoom in on this by hitting the plus key, this also is a good example of our Elliott two-wave system. If you had shorted somewhere on this little move up right here, you would have broke even or lost on it, small amount. You draw your fibs on there, and most of the time, the first or second fib target, this is called our Elliott two-wave counter trend system. It's a phenomenal place to get short from 53 all the way to 58. And again, your odds go up when you use a range chart. Notice, let's say you sold this first retracement right here because it was extremely weak. Right, you're short. You have your stop right above the bar's high right here. And when it barely goes your way and it comes back up and goes sideways, you might want to lower your stop a little bit. You would have lost about 8 pips there. And then here's your next area. You go short, and your stop is right above the bar's high. And, your profit target is the previous day's low right here at 15. You're going to go short at 47. So, it's about 30 pips away. You're going to risk 10 pips to make 30 pips. And this went down and then kind of went sideways right here. You might have exited half your trade with only 10, 15 pips. And then it came down and went kind of sideways, and it lost some of its weakness right here. I personally would have been out of the trade somewhere up here at 24. I would have probably got out of half at 34 and half at 24. That would have been my exit. My average price exit was around 30. I would have been short at 47. I would have made 17 pips while risking about 10. Now, whenever the price goes sideways, this is another one of our entry methods, and breaks down underneath here, you go short. And, typically a good place to put your stop is right above that little sideways rectangle. The closer, the better, because you have a lower risk. And it slightly went my way and then kind of went sideways. And at this point, when it goes down again, I'm moving my stop down above here. And when it kind of made a little bump up here and started going down again, I'm going to move my stop here. So you reduce your risk over time. You also have a fib area from here. And so when it goes down to this first or second fib area, if it stalls here, I'm out of the whole thing. If it stalls here, I'm out. And so I would have probably got out somewhere in the middle of this bar here at 85. You're short here at 15. It went about 12 pips against you. And then ultimately we're out of this trade somewhere around 85. You made 30 pips while risking maybe 15 in this case. So it's a 2 times bigger win versus risk. Now, the New Zealand also was extremely weak today. New Zealand, I'm just going to briefly show these charts. The New Zealand dollar, look, this went sideways here, nice little sideways rectangle pattern, broke down. You're short. this really isn't enough of a pullback. Well, actually, it is. It's about a 15-pip pullback. It barely meets our requirement. And you can see another sideways rectangle pattern right here. And fib targets make excellent places to get out of your trades. Notice it's stalled here at the fib target. It's at the lower band. I would have probably got the whole trade here and somewhere around 37 versus 17. So it did go down another 20 pips. I wouldn't have caught that. And this is not a bad pullback trade right here. It went up about 25 pips. You go short, you would have made another 15 to 25 pips on that. Let's look at the New Zealand yen. Again, price is underneath the hourly. Now this one is not, it's probably the worst trade of the day because you have these fib areas right here which act as support resistance. If you sell right here at 88, your first profit target is here at 74. After your spread, you might make 7 or 8 pips on this. So you don't want to risk 10, 12, 15 pips to only make that many pips. So you probably do not want to take that trade. Now, once it does go down underneath the support area, you can kind of ignore it from that point onward. So this little pullback trade right here would have been a good trade. And until it breaks this major Fibonacci area, major support area, you don't really want to sell. If a support area gets hit twice and it can't bounce, when it does break it, all the stops are going to get hit and you're going to have a further downward move. So selling it here at around 55 is a good trade because the next support areas are lower band and all the major support areas down here. 20-day moving average, monthly pivot, weekly pivot, another resistance or support area. So if you count the number of pips from 58 down to 34, you got a 24 pip potential profit while risking maybe 10 or 12 pips. And the fact that this found the support area and didn't get a bounce off of it, and the fact that the daily, weekly, monthly trend's down makes this a very high odds trade, maybe 70% likely to work, and it's likely to give you 2 times more profit than your risk is. So therefore, you pull the trigger. Now, this trade earlier was likely to work because the New Zealand was one of the weakest currencies, but it doesn't meet the second component of what you should be looking at, which is estimating what your profit target is and relating that to your risk. You don't want to risk 10 pips to make 10 pips, or risk 12, even worse, risk 12 or 15 pips to make 10 pips. It doesn't make any sense. You got to pass on those trades. So last but not least, let's look at the pound later. Anytime you have a bar at and above the 100 level, it's extremely likely to continue, especially 2 bars in a row. You can see that here, a few instances possibly in the dollar, or not necessarily, and those trends continue. The pound New Zealand, very likely to continue trending up. Selling the euro pound also made sense. Let's just take a look at these charts real quick to end the blog. Pound New Zealand, you can see just up, up, up. Euro pound, also a good one to sell. And you knew about it way early in the day. Just down, down, down. The Swiss was weak today. Pound Swiss is going to go up. Dollar Swiss was strong. It's going to go up. Swiss yen is going to go down. As you can see, lots of opportunities using our currency meter. And you don't want to buy or sell 2 weak ones or 2 strong ones. So the Australian, New Zealand, very choppy because they're both weak. So you can avoid, choppy, hard, almost impossible to trade markets by using the currency meter.